Today I'm going to show you how much higher time frame analysis you actually need to do before taking a trade using Elliott Wave. The video comes from a question that we received a couple of days ago where it says, I noticed that it is easy to apply in stock and index markets because higher time frames typically move in impulse waves. However, in the Forex market, even on the monthly and weekly charts, the price action is sideways, choppy, and overlapping, making it very difficult to identify the pattern. As a result, I experience analysis paralysis and struggle to step down to lower time frames. If I want to enter trades on the hourly or 15 minutes time frames in Forex, is there a way to do so without having to count waves all the way down from the monthly and weekly charts? So let's try to answer this question in detail. In order to do that, I'm going to show you a chart of a Forex market, completely and fully analyzed. I'm going to start with the monthly chart. Okay, so let's begin. This is going to be the euro dollar. So in this market, we can see a very clean, very easy triangle here. And of course, because of that triangle, it makes it clear that the move from the top is an A, B, C. Everything else moves in 3 exactly as this viewer is suggesting. Everything moves like an A, B, C, and then an A, B, C, and potentially an A, B, C that you can see in red here. So for now, we have labeled this chart as an ABC for a W. The next ABC we label as an X, and the next ABC as a Y, counting the entire correction as potentially fully complete. So thereafter, we count a wave 1 because it looks very impulsive to the upside, an ABC down as a wave 2, and another impulsive looking advance as a wave 1 of a minor degree. That means that we are still waiting for a wave 2 to be completed before prices move higher on a wave 3. Alternatively, we have this A, B, C in red, which means as a potentially alternate count, since we have a W, X, Y, this could be an X preceding the last move to the downside. That would be a Z. So that's an alternate count. Let's focus for a moment on the preferred count, which is a 1, 2, 1, 2. So you can see that in the monthly chart, the 2 is incomplete. We're waiting for prices to move lower, perhaps to the 50 to 62%, which is the typical distance that a wave 2 would travel. So for that, let's move to the weekly chart. We already know what we are expecting. We expect prices to move down on a wave 2, right? So here we can label the details of this suspected wave 1 as a wave 1, 2, 3, triangle 4, and 5 of 1. And now we are expecting this wave 2. Still, as I said before, still down, looking for the 50 to the 62% Fibonacci retracement. And well, in this time frame, we can see we had a downtrend line here that we expect not to be penetrated to the upside if indeed this is an ABC down. And we also have this blue line here, which is nothing but the neckline of a potential head and shoulders pattern, where this would be the left shoulder, this would be the head, and this would be the right shoulder. So penetration of the neckline would imply prices would travel a distance similar to the one from the top to the neckline, meaning that the 50 to 62% is arguably correct. So notice that now we have the monthly chart, we have the weekly chart analyzed, and they both coincide in direction. So now let's move to the daily chart and see what it gives us. The daily chart, moving from here, shows a potential 5-wave move down, an A, B, C up for a potentially wave B, and now we're expecting a wave C down. We know about wave Cs that they develop in 5 waves, and this move here, for many reasons, cannot be counted as a 5-wave move, not yet. So far, we expect it to be a five-way move still in development. So basically what we're looking is for prices to continue moving down from this wave B. Remember, we expect those prices to continue moving down without penetration of this downtrend line and eventually having penetrated the neckline of that potential head and shoulders. Now we go to the 4-hour charts. I'm just showing the potential sequence that we would follow, and let's look for that wave B up. That would be here, and we can see here we have a 1, 2, possibly 1, 2, 3, 4, and expecting that move down still for a wave 5 of that wave C that we would like to see. So now we go to an hourly chart, and in the hourly chart, what can we see? Well, we expect prices to continue moving down, and what we see here, which is key, and this is probably where the answer to your question lies, is that we see a movement from here to go up, down, and up. So basically what we see here is a 3-wave move. With this, having a 3-wave move alone, that would be enough for us to take or adopt a bearish stance. Why? Because 3-wave moves implies that this move from the bottom here is a correction. And what do we know about corrections? We know that corrections tend to be fully retraced, meaning that if this is indeed a correction, prices will eventually come all the way down here or even beyond that. With the context that we have seen moving from the monthly down to the hourly chart, we know that that makes sense because we're still expecting a wave C to develop to the downside. So I hope that gives you the clear idea that the higher time frames give you perspective. The lower time frames give you precision. So great traders know the difference and when they have enough information to act. For instance, if what you are looking for is a short-term trade, a swing trade perhaps, but short-term, all you need is to see that this is an ABC up. So basically all you need is to know the difference between a 5-way move versus a 3-way move, and that would be enough. You would not need to go all the way up to the monthly chart. So the purpose of the monthly or even the weekly chart is not to tell you what trade to take today, what trade to take next or to take tomorrow. The purpose is to tell you the story the market is trying to write. And once you know the story, then the time frame really becomes irrelevant because 15-minute chart, 10-minute chart, 20-minute chart, or even a 5-minute chart becomes absolutely easier to read. Because, for instance, why do we have this confidence that prices should be coming down? Well, we have that confidence because of the story that we have understood from the monthly chart. So all you need is a 3-way move or a 5-way move. If what you need to do is to take a short-term trade, seeing that 3-way move, or even, for instance, take from here, we see a 3-way move here, right? So once the prices penetrate key levels or critical levels of support or resistance, it implies that those 3 waves are already in place. And once that we have established that those 3 waves are in place, well, the next move will have to be to the upside, because we know that the 3-way move that you can see here will be fully retraced, as it was. And then in this particular case, now we're talking from here, right? But what about from here? Well, from here, we can see that it's a 3-way move, and we know that it will be fully retraced. So we expect the price move to favor the downside. So if you like this video, you may want to like it and subscribe it. And I will see you in the next video. I hope this video answered fully the question, do you really need to count Elliott Wave from the monthly chart in order to take a trade? And the core answer, the quick answer is no, you don't. You only need to differentiate between a 3-way move or a 5-way move. But if you want to have the entire perspective, the entire context, the entire history, then yes, it is imperative that you go to higher time frames. And it's also important to know that sometimes we have this idea that the market that we trade is different from other markets. The idea that a Forex chart looks different from a stock chart or from any other instrument or financial asset is not entirely correct. While markets do have a personality, a chart is a chart, and the patterns observed by Elliott on the charts are exactly the same whether you trade forex, stocks, cryptos, futures. It does not matter.